Hey everyone! Today, we are diving into China's economic landscape and why it's a big deal for the global economy. Now, you might be thinking, another article about China's economy? But stick with me, because this one's got some interesting insights and a unique perspective. Let's break it down. First off, China's July price data is like a snapshot of its economic health at the halfway point of 2026. The Consumer Price Index, CPI, rose 0.5% year-over-year and dropped 0.1% month-over-month, which is actually a positive sign. The Producer Price Index, PPI, is also up 3.5% year-over-year, but it's a bit of a mixed bag. So, what does this mean? Well, it's all about the balance between prices and demand. The CPI reading is consistent with moderate price growth, which is good news. But the core CPI, which excludes food and energy, is what's really telling. It's up 0.9% year-over-year and 0.3% month-over-month, indicating some solid underlying demand. Now, here's the interesting part. The retreat of international crude oil prices is a major factor in the month-on-month declines. This short-term adjustment doesn't change the bigger picture of gradual price firming since the beginning of the year. In the first half of the year, the CPI rose by an average of 1%, the core CPI by 1.2%, and the PPI by 1.5%. But here's the catch. The average CPI growth is still below the government's annual target of around 2%. So, what's the solution? A stronger and better coordinated fiscal and monetary policy mix. This would boost aggregate demand, spread price increases across sectors, and make that annual target more achievable. Now, let's talk about the bigger picture. China's GDP reached a massive 69.57 trillion yuan in the first half of the year, with a real growth rate of 4.7%. Services expanded by 5.2%, and industrial enterprises saw a 5.4% increase in value added. But here's the cool part. High-tech manufacturing and equipment manufacturing are leading the way with growth rates of 13.3% and 9.3%, respectively. This sectoral composition shows that stable aggregate growth is happening alongside industrial upgrading. Industrial profitability is another key indicator. In the first 6 months, revenue at industrial enterprises above a certain size increased by 6.5%, and total profits rose by a whopping 18.7%. Their operating revenue profit margin hit a high of 5.7%, which is pretty impressive. This improvement is thanks to policies that curb involution-style competition, like excessive price cutting and duplicative expansion. These policies are promoting more orderly market competition, which gives firms the space to invest in research, product quality, and technological upgrades, thus boosting innovation. Now, let's talk investment. Fixed asset investment declined by 5.7% in the first half, but when you exclude real estate development, the decrease is only 2.7%. Real estate development investment fell by 18%. This slowdown in investment is intentional. It's allowing for inventory adjustment, reducing price competition, and stabilizing the property market. Plus, investment is shifting towards activities linked to technological progress and productivity growth. Here's where it gets really interesting. China's stable growth is a big deal because the global economy is weakening. The IMF's July update lowered its global growth forecast for 2026 from 3.3% to 3.0%. But get this, the IMF raised its forecast for China's growth by 0.2% to 4.6%. That's a significant increase, and it's a testament to China's economic strength. China's sustained expansion is creating demand, investment opportunities, and policy predictability, making it a crucial anchor for global growth. Trade is a direct link to how China's growth impacts other economies. In the first half, China's goods imports and exports increased by 16.9%. Imports rose by 22.1% to 10.74 trillion yuan, which is a huge deal. It means China is converting domestic demand into production and income abroad. Trade with Belt and Road partner countries grew by 14.8%, and high-tech manufacturing and mechanical and electrical product exports are supporting international supply chains and the green transition. So, what's the policy takeaway? Domestically, stronger fiscal and monetary coordination can make the price increase more widespread and durable. Internationally, China's stable growth, expanding imports, and industrial upgrading are providing demand and predictability in an uncertain global economy. The July data supports this broader assessment. Prices are rising moderately, underlying demand is strengthening, and the economy is stable with room for further expansion. In conclusion, China's economic story is one of balance and growth. It's a fascinating case study in how a country can navigate economic challenges while maintaining stability and contributing to global growth. So, what do you think? Is China's economic strategy a model for other nations to follow? Let me know in the comments, and don't forget to like and subscribe for more insightful content.